Welcome back to Know Your Numbers. Aside from the basics of understanding what your financial statements are telling you, the topic of cash flow and managing it effectively will be the single most important financial discussion we cover here, and absolutely the most vital to the success of your business. We are going to cover what cash flow is, why cash flow problems occur, and some basic strategies to manage them. Hi, Carol. I'm sure you run into cash flow problems pretty often in the course of working with your clients. What kinds of things do you see, and can they be avoided?
Well, Ross, they can be avoided, but one of the number one question that I get, and that you get also, is why does it look like I am profitable, but I have no money? I'm excited to share this section because this section explains how you can be profitable and still not have any money.
Okay, and that's a very important point. And I think what I run into often too is there's a lot of what we call checkbook management going on, and with no system to understand what their cash flow might look like today, tomorrow, down the road. So we're going to take a look at all this. And there's a significant amount of material we're going to cover. It'll be longer than our typical session, but let's move forward and get started.
Okay. The third financial statement we present is a cash flow statement. We have taken the liberty to create a more practical and usable spreadsheet for the small business owner, rather than the official technical cash flow statement. For our worksheet, we calculate cash flow with information from the profit and loss and from the balance sheet. And please note that we've included the tax return. Why? Because if I look at the financial statements from a small business owner's point of view, I include estimated taxes as a source document needed to complete the cash flow statement. This is a bit unusual. However, for this presentation, we have taken a very practical view at how to interpret information and tried hard to remove business terminology and accounting lingo. That being said, to calculate a cash flow, one item that is almost always left out is taxes, because a small business owner does not have the luxury of having a tax accountant on site, estimating tax payments monthly. And we all recognize that this is a large liability that we have to pay. So when calculating the cash flow, find your previous year's tax return, pull out the estimated tax payment form and use them. Insert them into the cash flow worksheet that we supply later. And remember, they are estimated amounts that you owe, but you have to start somewhere. We will show you later where to input this into the worksheet. And relax, as a small business owner, you know way more about cash flow than you think, because that's how you've been operating your company. But we're going to show you some other techniques to how to actually analyze it. So next, let's look at why cash flow is not the same thing as profits. In fact, they can be very different. As I said before, businesses can be profitable and still fail due to lack of cash and planning. It is not uncommon for a business owner to say, my profit and loss shows that I made a ton of money, but I don't see it. Well, here's a quote I took from Fundera that we'll use to explain this topic. Profit is the revenue remaining after deducting business cost, while cash flow is the amount of money flowing in and out of the business at any given time. Profit is more indicative of your business's success, but cash flow is more important to keep the business operating on a day-to-day basis. And from my own practical point of view, the net profit does not account for payments of loans, equipment purchases, inventory purchases, money received from a loan, etc. So next, we're going to have Ross tell us about his perspective of the cash flow statement.
So as Carol and I emphasized at the end of the financial metrics session, the importance of cash to your business cannot be understated. It allows you to maintain operations, pay down debt, and pay yourself out of profits. Sales and income fluctuate in most businesses, sometimes month by month. Add in the seasonal nature of Vermont's economy, and you have a recipe for running dangerously low on capital when you need it most. And when you need it most is not the time to approach a lender for it. There's one very simple reason for this. In my experience, it will be painfully obvious to them that there has been no planning or monitoring of cash flow, which indicates a management problem. Lenders will happily lend into growth situations where a business shows foresight and planning. They will also lend to those who can demonstrate profitability, but identify seasonal lulls in income that they may need help with. They are generally not sympathetic to management failures And those folks who make that mistake will be left to find other sources of capital, and frankly, they should be. We are here to provide you with information and tools to help you avoid this stressful situation. Carol?
Thanks, Ross. All right, let's talk about this cash flow toolbox. What do you need to produce a cash flow statement? First, I would suggest a formal bookkeeping system, if possible. However, you're free to use a spreadsheet. You don't have to be boxed into an accounting system. Then make sure that bookkeeping is set up correctly and accurately, no matter how you capture the information. So how do you do this? So for some practical points of view, review the profit and loss. Does it make sense? Compare our profit and loss examples to yours. Are the categories placed in the appropriate places? 2, does it contain only business expenses? Make sure personal expenses are not included. Review, that means your own personal, this does not mean, if you use your credit card to go pay for a business expense, that's something different. That should be in the profit and loss. Review the balance sheet. Make sure the bank balances and loan balances match their statements. That rarely is that done, but that's a really good clue for what's going on. Then look at the accounts receivables report. Ask yourself, is this a true indicator of who owes you money? Do the same thing for accounts payable report and ask yourself, is this also a true indicator of who owes you owe money to? All right, step 3, obtain a 13-week cash flow projection worksheet. We will provide a link to one later if you don't have one available to you, and that'll be in our resource guide included at the end of our presentation. And then lastly, make sure you include all sources of money. I alluded to this a second ago. For example, if you use your credit card to buy items for the business, include this as an expense to the business. If needed, get a credit card only for the business. And on the flip side, don't put money into your personal account for items that you sell. Here's my lecture. Only use the business banking account for business transactions. So Ross, what can cause cash flow statements if you have this toolbox?
Well, Carol, it's a rather lengthy list. And so I need to spend enough time on it to do it justice. So folks, please stay with me here because we're going to take a few minutes to go through these. Okay, so let's look at number 1. Start with enough cash from the very beginning, please. There can be exceptions, but a total of 3 months of fixed operating expenses should see you through most temporary or seasonal lulls in revenue. Far too many small businesses try to make a go of it undercapitalized, either because they do not plan or underestimate what will be needed. Number 2, no amount of planning will compensate for inadequate sales or weak profit margins. If gross profits are not adequate to cover fixed operating costs on an ongoing basis, there is a problem that must be addressed and you will not borrow your way out of it. Many try. It usually doesn't end well, which leads to number 3. Repeatedly borrowing to cover operating losses or make capital purchases before the business can afford to can become a death spiral very, very quickly. Lenders will abandon this business quickly, and the instrument of choice becomes credit cards or usurious lines of credit. Additional loan payments and mounting debt add pressure to an already overburdened cash flow problem. Again, it usually doesn't end well. Number 4, it's the opposite of inadequate sales, rapid growth, and that can create problems as well. The manufacturer that earns a $300,000 contract from the federal government has to plan for the initial outlay of cash for materials, labor, and fixed operating costs to fulfill the contract and wait 60 to 90 days to get paid for the work. They often don't have any other revenue coming in. They need to plan for how those expenses will be covered up front before even bidding on the contract. Make sure you have access to the needed capital. 5, the same scenario as number 4 can happen to the seasonally dependent business. I had a client, a nursery, who earned all of his revenue from May through August and needed $150,000 to buy supplies and material and pay labor to prepare for the selling season and cover profits for his family to live during the off season. It was a profitable business, but he needed a plan and a line of credit to solve the problem. 6, if you sell to customers using credit terms, these must be managed effectively. It is not unusual for businesses like this to have 50% of their sales, or even much more, completed by providing trade credit. If you have this policy, it needs to be managed carefully and effectively. We'll talk more about that in a little bit. Often businesses will encounter suppliers who insist on being paid on terms that, after you have established yourself as a reliable credit risk, are just too restrictive. More advantageous terms can often be negotiated. And 8, finally, not having a system to allow you to monitor and project cash flow out at least as 3 months puts you at a decided disadvantage. Such a system can allow you to avert trouble well ahead of time when it becomes too late and a solution becomes too expensive or worse, completely unavailable. So let's take a look at that tool now. Okay, a 13-week rolling cash flow projection is a business owner's best friend here, and it can help you monitor and foresee problems before they cannot be solved easily or inexpensively, and help you to develop a solution. The slide here as an example. This is simply a week-by-week forecast of inflows and outflows of cash. It is not a profit and loss statement. You start with an opening cash balance at the beginning of the week. On the income side, this accounts for day-to-day sales, collections of accounts receivable, and any needed cash injections from sources other than operations if they are needed during that particular week. On the outflow side, you will enter expected operating costs, payroll expenses, loan payments, and owner compensation the week that they are due, as you can see on the slide. Okay. Once completed, you can have a weekly picture of what your cash balances are likely to be each week up to 13 weeks out. The next step would be to update the projected figures with actual numbers at the end of the week. The next 12 weeks forecast will change, and you would add another column at the end of the chart and add new numbers for that week. So let's take a look at the example here, okay? And we've basically compressed this a little bit so that we can use, major categories so that we can use, for space purposes alone. And we looked at only 3 weeks of results. We're suggesting a 13-week projection, okay? So as you can see, all right, we've got a particular problem in this particular scenario. So you'll look at the week 1 in July, and you'll see the opening cash balance of $15,670, all right? And from there, you'll see that there's total cash available of approximately $33,300. And the cash that flows out below that, payroll, accounts payable, and we do have some loan payments and credit card payments due as well. So the end of that week's activities on a projected basis, based on numbers that we know, based on historical and what we can foresee, we've got ending cash of $17,749. All right. Week 2 is where we potentially run into the trouble. All right. So we forecast again what the accounts receivable receipts are going to look like. And we've got cash available of $33,887. However, we have to make a major inventory purchase, and we have to buy a piece of equipment. So as you can see, the inventory purchase requires $25,000 that we have to pay out of cash, along with the down payment for the equipment. This leaves us with a negative cash balance at the end of the week on a projected basis. So we have to react quickly in advance, plan how we're going to deal with this. All right, and we're going to show you a possible solution for this in the next slide. However, as you can see, the following week's worth of activity shows that cash balances are going to be restored back to normal levels, very shortly. Once once more receivables and once more cash receipts come in. So what's the solution? We'll take a look at the next slide. All right, so here we are. So as you can see at the beginning, we have the same numbers, but we no longer have a negative cash flow balance. And the reason being is that this particular business owner had in place, had foresight and planned to have a line of credit available to handle any kind of a cash shortage. In this particular situation, the business owner drew $15,000 to the line of credit and added it to his checking account so all these bills can be paid, all right? And that restored the balance down at the bottom of week 2 to $13,240. All right. And as you can see again in week 3, nothing else has changed. These are the same figures. You can see a strong balance in cash at the end of the week of $31,507. The owner could, if he chose, to pay that line of credit back, all $15,000 plus the interest that might be due for a week's worth of activity, and put his and find his cash balance back to normal levels. So that's one example of how you use the cash flow projection to anticipate a problem and then find a way to solve it by being prepared. So next, how do we manage cash flow? All right, so let's walk through a few scenarios here. Okay, as I mentioned earlier, we have to maintain adequate sales and gross profit margins. We've discussed before, lack of sales and weak margins will absolutely destroy your business, and there's no amount of planning that's going to correct that. So if you're finding that you're constantly running low on cash, it means you're probably operating on losses, and your profit and loss statement will confirm this. So you need to address that immediately. Number two, manage accounts receivable. Okay, oftentimes when a business offers credit to their customers, all right, there's times where you offer those terms at a reasonable pace. Oftentimes it's a net 30 days, all right, and that means your customers are expected to pay you in 30 days time. Now, there's a tool that Carol will mention, has mentioned, I'm sure, called a accounts receivable aging report. Now, if your customers start to creep out past 30 days without paying you, that needs to be dealt with very quickly and sometimes even a little bit aggressively. You need to inform your folks that you need to pay your bills on time. So when an account goes 30 days past due, an immediate phone call is in order. So you need to work on that. All right. So don't allow receivables to run out 60 days, 90 days or more. The earlier you tackle the problem, the better off you're going to be. All right. Number three, negotiate vendor terms. All right. Oftentimes a business will pay their bills immediately when they don't need to, or we have vendors who simply have not loosened up the rules when a business has actually demonstrated, that they're a solid credit risk and should have better terms. So if this is you, I would go immediately to your vendors and ask for better terms. If you're required to pay for a product COD, you have every right in the world to ask for 7 or 15-day terms. It loosens up the demands on your cash if you do so. All right. Additionally, there's no benefit whatsoever to paying a bill that's due in 30 days the day you receive the bill. All right. Again, it ties up your money needlessly, and you should make sure that you pay your bills on time, but simply no sooner. All right. Next, use credit effectively and efficiently. All right. I mentioned before that oftentimes if you're operating on you're suffering operating losses and you're borrowing, that's a sign of trouble already. But having a line of credit or something, another tool to pay your bills on time so that you don't run into trouble with your creditors, makes a big difference. So there is an ability that you have to work effectively and efficiently with credit. And if you're not sure about how to do that, contact an advisor or your accountant and get some counseling on it. It's very important. Okay, what other things can we do? All right, your profit and loss statement can provide clues here. All right, your largest operating costs sometimes can be reduced. And if you're focused on looking at these constantly, sometimes you can save yourself some money and reduce the pressure on cash flow by trimming those expenses. And this next one is a simple one, and one that's often not dealt with effectively, are your payroll costs. It's one of your most controllable expenses. Manage hours. I had one particular scenario where I had a business that sales were down 20%. It was right at the very beginning of the pandemic, and yet they were still paying overtime when it was unnecessary. That is a situation that has to be managed closely, and you've got to make sure that you do it sensibly. So you can't pay out payroll expenses when the revenue is not there to justify it. Next, and finally, manage your inventory and your assets. Okay, if you're a retail store, clear out inventory. All right, if things haven't sold in 60 days, start discounting it and moving it out so you can free up the cash to use for other purposes. All right. Oftentimes, businesses will have excess inventory on hand and it's simply not necessary. A lot of vendors can deliver inventory in 24 hours. So there's no reason to really stockpile on excessive inventory. Get it only as soon as you need it and not before. Finally, sell unneeded assets. Old equipment or aged inventory are not assets that you need to have laying around. Move them out quickly, put the cash in your pocket, and have it for operating costs. All right, so that would be the end of the discussion here. So Carol, we covered a lot of material there, a lot of things to think about and move forward with. So is there anything there that you'd like to add or you think you'd like to emphasize before we move on to our next topic?
Sure. I just have a couple of points. I have found that people are more successful if they carve out Monday morning as their own business day, working on your own business. This is the time. Monday has, it's going to start off to be a really rush week, but the weekend has happened. You have all your balances from over the weekend in the bank. Take a look at them then, work on them as they come in. Also, match your payments received from your customers. So when your customers pay you, then you pay your vendor bills. That may not make everybody happy, but it's a good practice. Another one is just getting to know your bookkeeping system and the reports that it produces. Get to know your commercial lender. You talk about an advisor. A commercial lender at a bank or the Vermont SBDC is an excellent resource, as is some accountants can also be a resource to help out with this information. And be disciplined in knowing your historical and projected cash flows. Knowing that will make you so successful. You benefit from early detection of issues, quicker response time to issues, and the success of the company and increased profitability just flow from having this information. So I think those are my final thoughts. Ross, how about you?
Well, those are outstanding suggestions. Again, you can't overemphasize the value of actually looking out ahead into the future. You know much more than you think. And if you use, especially if you've been in business a while and you're using your historical numbers to predict what's coming in terms of revenue and expenses, you really have a leg up on this. And even those short-term hiccups that occur can be managed easily, effortlessly, and without stress. And God knows, small business owners have a lot of demands on their time and under a lot of stress frequently. So, I mean, the more things you can do to minimize this, I think the better off you are. So, okay. So we've covered a lot and we're coming down toward the end here. So next time in our final session, we're going to take a look at a bit of a catch-all of financial management tips and topics that came up during our discussions as we produced the series. We're going to go through those and we'll hope you take the time to join us.